Welcome to Accounting with Madam Mombi. Today we are going to look at master budget. So we are going to start by defining what is a budget. So this is a very common terminology that I believe we are conversant with, because a budget is simply a plan for the future expenditure or revenue. So you're planning or you're forecasting what is your expected future cost on a certain function or in a certain department, or what is your projected future revenue. So simply a budget is a plan that is expressed in quantitative terms, that is in terms of quantity or money for a future cost or a future revenue. So the whole process in which we prepare budgets is called budgeting. It refers to the process of quantifying the plans of an organization to help them to achieve their objectives within a defined period. So the whole process of preparing budget is called budgeting, and the results which are budgets are useful. So you can also wish to know what are the uses of budgets. Number one is planning. They help you to plan for the future. They help you to resource allocation, to allocate resources. Budgets again help you in performance evaluation, where you can compare the budget against the actual performance to evaluate the performance. Budgets also can be used for cost control, so that you can take corrective actions when there is deviations from the budget. And automatically, on all those aspects, the budgets are being used for decision making. So those are the purposes of budgets. So in our continuation, then we can look at what is a master budget. So a master budget is a combination of many functional budgets. A master budget is one framework that combines different various departmental budgets into one budget, which then can be used to see the picture of the whole organization. Specifically, in a master budget, you may have other smaller budgets like this. You can have inside it a sales budget. Inside it, you can have a production budget, material budgets, labor budgets, overhead budgets. You can also have other non-production budgets like the selling and distribution budget, the administration budget, the cash budget, research and development budget. And all these budgets together are combined into the profit and loss and the budgeted balance sheet. So those are what we mean when you call a master budget. Now, from one specific question, we may not be able to achieve to get all the budgets, but at least from one question, we may be able to do at least 3, 4 to 5 budgets. So specifically, we can have a look at this question that is here. It says that Blitz Limited produces 2 products. The 2 products are Flex and Lux. The budget for the next year to 31st December 2024 is to be prepared. Expectations for the forthcoming year include the following. The finished products is expected that the sales director has already estimated that the demand for the company products is going to be as follows in units. They are expecting a demand of 4,500 units of Flex, and they are estimating a demand of 4,000 units for Lux. That is the expected demand. So this has been approximated already by the sales director. It is expected that the selling price per unit is going to be shillings 32 for Flex, and the selling price per unit is expected to be 44 shillings for Lux. So again, this is expected or planned because we are preparing a budget. Further, you are told that the closing stock on 31st of December 2024 is required to be, these are the stock levels. Because again, in an organization, they have to identify what are the expected stock levels. So for the finished goods, they expect that at the end of the year, they are going to have 400 units of flex, and they're going to have 1,200 units of lax in stock. That is the expected closing inventory. Whereas at 1st of January 2024, the opening balances or the opening inventory are expected at 900 units for flex and 200 units for lax. Now, to produce our items here, we are going to use two types of materials. The raw materials that are used in production, you have material A and you also have material B. Those are the materials that are used to produce flex and lax. And specifically here, you are given the number of kgs. So this simply means that material A, we require 1.5 kg for every unit of flex. Material B, we require 2 kgs for every unit of flex. Material A, we require 0.5 kgs for every unit of lax that is produced. And material B, we require 4 kgs for every unit of lax that is produced. Further, you are told about the labor hours. It is required that direct labor hours required for every unit of product is 6 hours for every unit of flex that is produced, and 9 hours for every unit of lax that is produced. Finally, it is also expected that raw materials, you are given the required closing inventory for raw materials. This now you have material A here and material B here, and you're given the expected closing stock of the materials and the opening stock, and also the expected cost of the raw material per kg. So with this information, you are expected to prepare some budgets from the master budget. Specifically, you are expected to prepare the sales budget, the production budget in units, the direct material usage budget, and the direct material purchase budget. And we are going to start with the sales budget. So our first budget is going to be the sales budget. Which you are going to prepare. Remember which our sales are of two components. We are going to be selling flex and lax. Then we are going to ask ourselves what is the expected demand, or what is the demand for the product, or what is the estimated sales in units according to the director, sales director. And we had been told that the director has estimated that the demand of the product, or expected sales in units, they were expecting to sell 4,000 units, 500 of flex, and for lax they're expecting to sell 4,000 units. So the sales budget, there is not much into it. We are also given the expected selling price, expected selling price. We expected that the selling price per unit is, for flex, it is expected that the selling price is shillings 32 per unit, and for lax it is expected to be shillings 44 per unit. So what we are simply going to do is to multiply and see how much is our sales budget in revenue, or in terms of revenue. So the sales revenue, or the sales budget in shillings is going to be given by that. So once you multiply 4,500 units at a price of 32, we are going to get a total of 144,000. And for lax, we are going to get a total of 176,000. And we can get here a totals column, but we don't need to get the total for these items. We only need a total here for the total revenue. And the total revenue is going to be 320,000. When you add the two of them, that is the total sales budget. So that is our first answer, which is the total sales budget. We can go to the second budget, which is the production budget. So we are going to look at the production budget. Again, remember we are producing flex. We can present it there, flex. And we are producing lax. Those are the two items that we are producing. Now, for you to prepare a production budget, you have to ask yourself some pertinent questions. Why are you producing? So production budget, you produce majorly to sell. So your first item in this budget is how much do you expect to sell. So we are going to start the production budget by first of all identifying what is the expected sales. Expected sales. Specifically in this budget, we are going to start with the sales in units. And from this budget, we are told that the expected sales, which was represented as the demand for the product, the expected sales is 4,500 for flex and 4,000 for lax. So the first reason as to why you want to produce is because you want to sell. The second reason as to why you may produce is to maintain a certain stock level in the organization. So you are going to add here the planned closing stock. You add the planned closing inventory. How much do you want to have as stock at the end of the year? Because you may produce to keep in the store. Therefore, what is your planned closing stock at the end of the year? So our planned closing stock at the end of the year from the question is given as 400 units for flex and 1,200 units for lax. So those are the number of items that we want of the two components in the store at the end of the year. So when you add these two, it gives you the total finished goods requirement. So these two give you the total finished goods requirement when you add. So the total finished goods requirement is 4,900, and the total finished goods requirement is 5,200. This is not yet the production budget. It is just simply the total finished goods requirement. So for you to know what to produce, then you have to ask yourself, if this is all I need, what do I already have? Is there anything you already have? So that if you already have some part of this finished goods requirement, then you don't need to produce what you have. So this is why you less the opening stock. You less the planned opening stock or the existing expected opening stock. Or the planned opening stock. So it is expected that at the beginning of the year 2024, there already exists some goods in the store, and it was said that the opening stock here was 900. So I'm saying you don't need to produce what you already have. So you subtract the opening stock, and the answer you get is your production budget. So what you need to produce is the remaining amount. So you need to produce 4,000 of flex, and you need to produce 5,000 of lax. So this shall be your production budget. In units, this is your production budget of units. The number of units you need to produce are 4,000 units of flex. Those are the number of units you need to produce. And you need to produce 5,000 units of lax. And as said, it is simply your expected sales. You add your planned closing stock, what you want to have to the store at the end of the year. You less what you already have, which is the opening stock. Then now that is your production budget. Okay, so we can continue to another budget. Material usage. material usage budget. How much of material do you want to use? Or how much of materials are you expected to use? So, it is expected that you're going to use two materials. You're going to use material A and you're also going to use material B. Those are the two raw materials that you're going to use. And because it is a usage budget, the next question is, what do we use materials for? We are going to use materials for production. And what do we want to produce? We want to produce flax and lax. 4,000 units of flax and 5,000 units of lax. Given that the production is of flax and lax, then you're going to see how much kgs do you require to produce 1 unit of flax. And we saw from our question, I can get back to the question. From the question, we can see that every unit, this is the information, that every unit of flax requires 1.5 kgs of A. And every unit of flax requires 2 kgs of B. Again, every unit of lax requires 0.5 kgs of A. And every unit of lax requires 4 kgs of B. This information here is the one you are going to be using to prepare the usage budget. So going back to the question, we can bring that information here as we have said, that you have said for material A and flax, you are going to be using 1.5 kgs. So multiplied by 4,000 units that need to be produced, you are going to end up using 6,000 kgs. And lax is also going to be using material A at 0.5 multiplied by the 5,000 units that are going to be produced, we are going to end up using 2,500 kgs. So for material A alone, we are going to use 8,500 kgs. That is how much of material A we are going to use. We are going to do the same for B. For B, we are going to use 2 kgs multiplied by 4,000, which is going to be 8,000 kgs. And the other one is going to be 4 kgs multiplied by 5,000. You're going to end up with 20,000 kgs. So at the end of the day, you're going to use 28 kgs. 28,000, kgs. And this is our material usage budget. This is our material usage budget in units. If you remember again from the question, we were told that material A is going to be costing shillings 1.5. This is the cost of material A, and material B is going to be costing shillings 1.0. So you can transform this budget into shillings. You can transform this budget into shillings. So the material usage budget, this time in shillings or in value, is going to be, you multiply, you're going to get 12,750, and this one you're going to get 28,000, and that is the material usage budget, but this time in shillings. So these figures are all given in the question. Our work is to match. You make sure you match flex and A, lax and A. You do the same flex and B and lax and B according to the usage. The table here seems to be transforming what you already had, because in our table, these items were the ones on the column, then the materials were the ones on the row column. That is why it seems to have transposed. Then we can proceed and prepare the material purchase budget. Material purchase budget. Again, which materials are we purchasing? It is material A and material B that we are purchasing. And as we are doing for production, we have to ask ourselves the question, why are we purchasing materials? The reason why we are purchasing materials is because we want to use. So our starting point will be from the usage budget. We are going to start here. How much do we want to use? We want to use 8,500 kgs. And this one you want to use 28,000 kgs. This is what is going to engineer our purchases. Or we are going to decide our purchases based on what do we want to use. So at this point, you may learn that budgets are interdependent. So we are going to start there and say that our expected usage, how much we want to use. We want to use 8,500 kgs. And we want to use also 28,000 kgs from our usage budget. Why else can we buy materials? We may also want to buy materials to keep in the store. We may want to buy materials to maintain a certain stock level of materials, of raw materials. So what is our expected closing stock of materials? So we are going to add the planned closing stock. Add planned closing inventory. How much do they want to have in the store at the end of the year? Our planned closing inventory of material was given as 600 kgs and 1,000 kgs respectively. So we are going to add, these are also in kgs. We are going to add and say that our total raw material requirements are, when you add 8,000 plus 600, you are going to get 9,100 kgs and 29,000 kgs. Those are our total raw material requirements, what we want to use and what we want to keep in the store as closing stock, or what we want to expect it to be at the end of the year as closing inventory. But we don't need to buy what we have. So again, we don't need to buy what we already have. So we are going to less expected or the planned opening stock. What do we already have so that we don't buy what we have? So we are going to less the planned opening stock. The opening stock of material is 1,100. The opening stock of material B is 6,000. So you are going to subtract. That, and you are going to be able to get then what is our material purchase budget. So this gives us the material purchase budget, and we are saying that we should buy 8,000 kgs of A, and we should also buy 23,000 kgs of B. So that is our purchase budget, how much we should buy of the two commodities. Remembering that we are buying these materials at a cost of 1.5 shillings, and this one we are buying at a cost of 1 shilling. So for every item, we can transform this budget again into shillings. We can transform this budget into shillings so that we have material purchase budget but in shillings. So multiplied by the shillings, you are going to get this to be 12,000 in shillings, and this one is going to be 23,000 in shillings. That is going to be our material purchases budget. So we again say it starts from how much do you want to use, how much do you want to have in the store at the end of the year, what do you already have. Then you buy what you don't have at the relevant cost, and that is the material purchase budget. So our final budget is going to be the labor budget. So our final budget is a direct labor budget, direct labor cost budget. So what do we use labor for? So that we can know what is our starting point. Of course, labor is used in production. So this budget is going to be engineered from production of what? Of flex and lax. And what was our production budget? We can go back and see that our production budget is 4,000 units of flex and 5,000 units of lax. Those are the ones we want to produce. Then going back to the question, we can have a look at how they use labor. The use of labor is given here. Flex uses 6 hours, lax uses 9 hours. So we already know how many hours each of the products is going to use. All we need to prepare is a labor budget. Again, from what we have discussed previously, the materials were also given here, the ones we have used, the material requirements, the closing stocks and the opening stocks, and the cost per kilogram of the raw materials. They were given as part of the question. Just in case you are wondering where we got the figures, they are right here. So going back to finish on our calculation, we can go back and finish on the budget. We are saying that we are going to produce 4,000 units, and for this you are going to produce 5,000 units. So we require 6 hours for this, and we require 9 hours. So the total hours that we require is 24,000 hours, and for the lax we require 45,000 hours. Once you multiply, so the total hours that are required is 69,000 hours. So this is our labor budget in hours, direct labor budget in hours. And we can change this by multiplying by the wage rate. The wage rate, we were told, is shillings 1.6 per hour. So that is the wage rate, so that we get the direct labor budget in shillings or in value. So the total amount of labor we are going to pay is 110,400. And that is the end of the labor budget. Also marks the end of our master budget for today. We have done at least 5 budgets from the master budget. And if you found this video to be helpful, kindly like, share, and subscribe. Thank you.